Do you get out of trades too early? Now, what commonly causes this is an inability to predict how a market is going to get from your entry to its target. Now, we looked at footprints, at candlesticks, at order flow to define entry points. But what allows you to predict what's going to happen is profile, and more importantly, this allows you to spot asymmetric opportunities, that moment that the trade tips from maybe working to it is going to work. Now, unfortunately, most people don't focus on this part of a trade. What they do is they get in and they assume that the market will move from point A to point B in pretty much a straight line. Now, this is fine as long as it does, but as soon as it doesn't do that, this is what brings in doubt. And this is where a profile is so important, because it gives you context of where the market should accelerate, where it won't accelerate, where it's going to get sticky, where it's going to be fast. What we're going to look at today then is a specific example of this, how to understand that move in the S&P from a contextual point of view. So let's dive into this trade then. What we found in the previous videos was a solid entry. We defined exactly where to do it, we leveraged the trade up using order flow. What we can now use profile to do is understand the move itself and also to give us a slightly bigger target. The initial target is to move up through the range, but using a profile, you can now see how actually this target can be enlarged. So let's go and have a look at what exactly is going on, where it can accelerate, where it will slow down. Right, what we've got here then is the market opening below the previous day's value. Now notice we talked about the potential to enter at around about 71, but in fact, using a profile, you've actually got an even better entry using the previous day's value area low at 69. Now, the target on this trade is 85. That's the top of this little box here. So all of that is reasonably well set. But if you understand what's going on from a profile, what you also have is a cave. Now, what a cave indicates is an area where the market is not traded. When you get into there, you can expect this to fill in. Now, for a market to fill that in, it has to spend time there. It has to move slowly. But the getting into the cave is where it accelerates. So the move beyond 80, you can expect the market to move quick, and then a more steady move as we approach the top of the cave at around about 90. So that's how you get this larger target on the trade. And what this comes down to is understanding profile principles of where a market is going to get stuck or not. Once you've done volume in a certain area, we don't have to spend more time there. Where you don't have volume, we need to spend more time and do more volume there, so the market gets stuck. If I show you this when the move actually happens, this is exactly what you see. As the market moves higher, so remember, we're looking at getting into the trade at 71. But in terms of what you can expect to happen, you can expect that yes, we can be quick through 81, which is what you see on this initial move. But once you're up there, this is where you can then expect the market to slow down. So whilst this would be the moment that most people sort of think, oh no, the trade's not working, I need to be out of the trade. Instead, this is the moment where you think this is logical, it should do this. And in doing that, it's actually doing the right thing for your trade, which then means that 90 becomes a much more realistic target and the market then moves up through that range. But if you don't have that understanding of the context, simply caused by where volume is more likely to be done and where it's not, you don't know how to run the trade. And this becomes an area where most people give up too early, don't maximize that opportunity. But in fact, this is the point where the trade has got the greatest probability of working, where it has become asymmetric. It's arguably the place where you can go and add on to the trade. That's what a profile does. It gives you that context. It gives you that ability to say, yes, this is doing the right thing, even though on your first view of it, it doesn't look nice, it doesn't look comfortable. So that's how you're looking to try and deal or use profile to deal with the management of a trade throughout the entirety of the trade, not just the assumption that markets move from point A to point B. That's why people get out early, because they don't have an understanding of what they really expect to happen on the trade. So like I say, profile is not just important for managing trades. It's important for understanding the general context of a market, of where you can go, because what profile allows you to do is see things from the perspective of value, not simply price. When you understand the value of something, you can assess whether something is actually too cheap, too expensive. And by having that ability, you can then know whether a market is willing to reverse or to continue any kind of movement.